Well, Sona Comstar or Sona BLW Precision Forgings came out with numbers which were rock solid, maybe on the bottom line front, mildly lower than what the Bloomberg estimates were. And they have spoken about how, due to the FAME 2 subsidies being pulled back, there's some bit of a pullback in the annual assumptions for the revenues from that side of the business, but made up by the deliveries in some of the others. But a 43 to 51% EBITDA and PAT performance in a quarter is a strong one. And Vikram Singh would be a happy man. He joins us right now to talk about the quarter gone by and the outlook ahead. Vivek, good having you. Congratulations on a good quarter.
Thank you, Neeraj.
Uh,
But yeah, I'm never a very happy man. I'm always moderately happy because there is always so much more we could have done. And there is always a little bit of, what if we had also done this? What if this had gone better? Always. So yeah, it's good performance. Wish it would have been even better.
Sure, but what went right? I mean, these are good numbers, Vivek. Independent of the fact that yes, they could be better, independent of the fact that the consensus expectations were already building this in maybe slightly more. What went right for the quarter, and what are the takeaways from this quarter for the quarters ahead?
Yeah, so look, net margins are actually improving, which means net profit has expanded by 50% over Q1 of last year. That's a big jump. It's a jump because of growth. And with growth, because our fixed costs are not very high, operating leverage always plays out very well for us. Second is commodity prices also will start easing soon. They haven't done that much apart from copper. When it comes to alloyed steel, that will also aid this recovery. And last, which is the actual thing of why everything grows, is the US markets have done well, and that's our largest market. European market has started recovering. Last year, this quarter, Europe only contributed 11% to our revenue. It's now 23%, so it's going back to where it used to be. I think these are the bigger reasons that the automotive market is now finally, after I would say 4 years of struggle, it's stabilizing. There is a lot of pent-up demand in the system. All that is being fulfilled despite record high interest rates in the Western world. We are seeing very good demand. I think this is the first quarter after 9 quarters that US light vehicle sales exceeded 4 million. Europe light vehicle sales were over 3.3 million. Once again, it is coming back to what I would say were pre-COVID numbers, and that bodes really well for the future.
Right. A word on the global economic front, though. It's as hard to predict as flipping of a coin. I'll still inclined to ask you one. Uh, the belief that US may skirt the recession, Europe may come back, hopefully, if things go all right. What does that do to end demand beliefs for the remainder of the year? Part two of my question, there is this overall belief that commodity costs will stabilize in quarter two, but if what's happened with wheat exports out of Ukraine is an indication, and if come winter, oil is another indication, and if China gives a stimulus because of the global economy that they are in, and that leads to a bit of a pullback into commodity prices, could that derail that assumption?
It could. I mean, we live in uncertain times. And one of the good things about our business, fundamentally, and allow me to be philosophical for a moment, is we embrace uncertainty. Uncertainty is actually a very good friend of ours. We tend to do quite well in these times because, one, if you look at our margins and you look at our growth, there is so much resilience built in that even these shocks that can really, really negatively impact more fragile companies, large companies with low margins, it doesn't do that much to us. So even if you look at Q1 last year, which was terrible, I mean, the war had just broken out, Europe had tanked, recession fears were raging everywhere, inflationary stuff. Our margins fell to the lowest it's been since we listed, 24.2. If you were to step back and say, hey, is it bad? It's not really bad, right? I mean, if you made 24.2% EBITDA, it's not a bad quarter. This ability allows us a lot of flexibility to do more things and different things in tough times. So we don't mind uncertainty. Now, coming to your first question, I think when everybody predicts something is coming, it rarely does it? I mean, this was the most highly predicted recession of all times, I guess. Uh, in the last year, I think everyone was saying it's a recession, and I think we might just avoid it. I don't know who it was, Friedman or someone who said that economists have successfully predicted 9 out of the last 5 recessions. So I think these things are always, and it is easier, right? I mean, if you're on a TV channel, or you sound wiser somehow if you're more pessimistic and talk about something that is. If you are optimistic, you sound naive. I tend to remain optimistic. We have built a business model which is very, very highly resilient. It may not be anti-fragile, as
Sure.
Taleb claimed, but it is very highly resilient. I mean, even in the COVID times when revenues went to zero, etc., we had about 45 days of shutdown. There was only about 1 month in which we actually made a loss in that whole year. So it is a model that does very well in uncertainty. So we're not averse to it. As far as calling it goes, we are not calling it. That's not our job.
Okay, but you've
Our
done,
job is to manage the company. That's it.
and you've done a good job out there. The product mix has enabled you to come back to circa 28%. If all goes well, you reckon these are numbers that you'll be able to maintain or better,
See, we've always held that for the last 20 years, our EBITDA range annual has been between 25 to 27.
and you will stay
There
there.
have been some anomalous years. This is the range we target. Beyond a point, increasing margins is also not ideal. I would rather trade that for growth, right? My job as the manager of this asset or this company is to balance growth, margin, and returns.
Sure.
Maximizing on one while sacrificing the other two is also not prudent. If I can sacrifice, let's say, 200 basis point of margin and get 5 to 10% more of growth, I would take that day. So it's a balancing act. If margins are going too high, also we need to know what we do. We take that either and share it with our customers or invest more in things that can grow future revenue. So it's a balancing act, Neeraj.
Okay. Now, your order book, at times I feel talking about your order book is kind of pointless because it's such a high book to bill ratio that, and it only builds on. So, which is good. I would love to understand the client conversations as they're shaping up currently, Vivek, because even the ITs, ERD companies which are into the EV space or automotive space are talking about very rich conversations. The texture of it, automotives just looks very, 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 very strong currently. What is your experience? What are the kind of conversations?
So you're right, because the ER&D guys, we have a bit of an overlap with them, to be honest, because some of the things they develop, like motor controllers or like the intelligent suspension, we also do the same thing. We are more hardware focused, but we do application software for our hardware. So there is an overlap. Conversations are interesting for anyone who's doing higher value addition engineering. The problems that the automotive customers are posing today are orders of magnitude more complex than they used to be, let's say, 10 years ago. 10 years ago, most conversations were commoditized and you talked to a guy in procurement. You didn't talk to strategic sourcing or engineering that much. But that's because, I mean, if you look at the industry last 10 years, because of electrification and increasing intelligence in vehicles, much more has happened in the last 10 years than has happened in the last 40. So it is the product of the change. And we are all people who can deliver bespoke solutions to, I would say, complex engineering problems will stand to benefit. Commodity players are going to find it harder and harder to retain their business rationale in this world. So it's shifting.
Wow. But I like what you said, Vivek. Can I just probe that a bit more? Would this therefore mean that if you are able to carry out those complex solutions, then not only you get the higher margin orders from clients and get married to them for a longer period of time, but you also have a foot in the door for, should you choose to, even the commodity pieces, which might be commodity by the nature of the work, not necessarily by the nature of the margins that they bring to the table.
True, because I'll tell you why. So why do we have such high margins? I mean, if you look at our industry, the average would be what, 12-13% EBITDA? Ours is literally double. It is because there is a lot of value that the customer is paying for the engineering time that goes out with each product, right? It's not just a product, it's developed literally bespoke for their specific problem. Because, so to understand our industry or any manufacturing in general, there is build to print, where a customer, this is what I meant by commodity, customer gives you the print or the design of the product, your job is just to manufacture. Then you come to co-design, where you help your customer with the design, and it's an interactive process. And last, you come to what we call build to spec or design product. Most of what we do is design. So we get paid for the design, we get paid for the R&D work in developing it. So it is that we are shipping out a product and we are shipping out many hours of work, which is why I said there is an overlap with the ER&D people, because we are doing both. What it allows you to do, so if you become problem solver in chief for your customer, right? And this happened with us, by the way. There was a product, I won't name the product category, which we have never done, never intend to do. But the customer said, hey, my supplier is having an issue with this. It's such a basic product. Can you guys help me? And we did. So sometimes you end up winning things inadvertently just because of this faith. Because if you become a customer's go-to guy for a particular engineering problem, like we pride ourselves that in the motor space and the driveline space, we become that person for the customer. That we will solve any problem that comes in this functional area. It does help, and people are looking for those, because understand that all OEs have much tighter timelines to launch their new electric vehicles. They need people who they can rely on and who can solve their issues, and not just give them what they have already designed. Contract manufacturing as the chosen model may not be the most relevant. It will not be the high margin, high growth segment for sure.
Got it. Couple of hygiene questions before we get to the final question, if you will. This is the maximum extent of revenue loss that you reckon would come in from the FAME to subsidies being pulled back, about 100 odd crores, 100, 120, whatever.
Yeah, I mean, we are a conservative company. We like to err on the side of cautions. I mean, if I look at July, we might be proven wrong, and then people should be happy about it. But you know, one swallow does not make a summer. So I don't want to just rely on. See, June was literally nothing, and then July has come back strong. I think we must watch the data for 3-4 months before we can make up our mind. So we went with the most conservative estimate, basically.
Okay. I don't know if this is conservative or this is realistic or this is optimistic, but a clutch of notes that I read pencil in almost the kind of growth that you've done on the bottom line or the EBITDA for the quarter as being true for every year for the next 3 years. I know it's too far out to think maybe in such an uncertain world, but I'm still inclined to ask this to you because it's a very impressive number.
For the last 7 years, if you look at our numbers, we've grown at a 30% revenue CAGR. For our 22-year existence, also we have grown at a 30% CAGR. So we expect growth to be robust. I don't think it'll be 50%. This quarter is also on the back of slightly weaker Q1 last year, and you know the margin expansion also happened, etc. But yeah, that's the kind of growth we have been targeting. And if you look at longer period, it comes. Yeah, there will be some years which have grown at 50 and some years which have grown at 15. But these, because see, our business grows in a step function curve. You get some massive orders, you come to a number. Like, I mean, you know, when we listed, we were sub 500 crore revenue. then we went to 500 crore plus, then we went 600 crore, then now we've come into 700 plus crore category. This is how it does. So it stays for a while in one orbit, if you may, and then as you get more power from new orders, you jump, the electron jumps to the next orbit, and you keep going to a higher orbit. That's how it happens. So that's the nature of our growth. It does not follow financial years and quarters so much, because that's not the cadence of our business. Business wins are, it takes 2 to 3 years to go from RFQ to SOP, and then it takes each order lasts 5 to 7 in motor and 10 to 15 in driveline. So they're long relationships. We are long term. Our business is long term just by the nature of what we do and who we are and who we work with. So the quarterly cadence is obviously not a very great one to really understand our business, but it's okay. We are also new. It's just been 2 years since we listed. With a longer time frame of being a public company, hopefully people will understand that we need to be looked at in 2 to 3 year cycles.
No, okay, let me try and rephrase that assumption. Sorry, one last question, which is that forget an exact number, but you've done better on the operational metrics, and the belief therefore might be that the company will grow at a faster clip on the bottom line relative to the top line because the margins look better. And the couple of notes also stated that there are upside risks to these estimates if the PLI benefits accrue, which is where this is coming from.
Yeah, they are upside risks, etc., etc. But again, I will go back to the first answer.
Fair call.
If margins increase a lot, there is a call to be taken that do you retain these margins, and then you just look at the highest level of abstraction. Any manager has basically 2 jobs, right? One, to generate a steady, sustainable, and growing cash flow stream. The second is to allocate this cash that has been generated back into the business and deploy it prudently at a rate of return which is similar or higher than what is already being generated. Both of these have to be balanced. If I generate a lot of cash and I can't actually then deploy it back, or I start deploying it back suboptimally, that's not a great business idea. If I can deploy it back into actually growing it further, and sometimes just offering, let's say, a 3-4% discount to a customer might be a much better investment than anything else that I could do with it. So yeah, it's a balance. We have always said that 25 to 28% is our EBITDA range long term, and 14 to 16% is our net profit range long term. We have always stayed within this range, and we intend to stay within this range.
On this forum, Vivek, we will not quibble about those numbers next time onwards. We don't have all the time to talk about the order wins and the nuance that you do. Maybe we'll do that in Q2. But point well taken. Thank you so much for speaking to us today. Congratulations on a good quarter and all the best for many more.
Thank you, Neeraj, and get well soon.
Thank you so much. And viewers, thanks for tuning in.